as I said, as Mike said, my name is Ron Mann. I'm the vice president of with Madison Capital Group here in Miami. And Madison Capital is a real estate investment and merchant banking firm. We really work very closely with developers and principals and sponsors in their debt and equity, financing. We also advise operators and owners and developers in a broad range of financial and transactional capabilities. We have helped place over $3 billion in debt and equity over the past 15 years, and restructuring and workouts, and very, very active. So that puts us in a sort of an enviable position when it comes to analyzing trends and analyzing different types of, let's just say, opportunities that have popped up on a cycle basis. And I don't think anything has been bigger in the past few years than opportunity zones. This panel, we're not going to spend time talking about what is an opportunity zone at this point. I think we've had many panels and speakers talk about that. We're going to get really more into the nitty gritty. And we have really panelists here today that this is what they do. This is their life. So I want to introduce Lane Lowry, who is with Qozportland, not Portland QOZ, Qozportland. Is that correct, Lane?
Yes, that's correct.
Awesome. Well, thank you. Thank you for coming to the panel. Let's start, and we have Daniel Ocean who will join us in a little bit. But let's kind of get into this. We talked a little bit the other day about some of the things that you're seeing in your city that obviously reflect other cities as well. But give me kind of well, first of all, give us a little background of you and of the company as well.
Sure. So we're located in Portland, Oregon. That's the skyline behind me. And the Opportunity Zone Fund legislation, which passed in 2017, was a surprise to everybody. It just came out of nowhere. And all of a sudden, we discovered that this downtown area that you see behind me is in an opportunity zone. There are over 8,000 opportunity zones, and the opportunity zones were designed to spur development in areas where the returns are substandard and to give tax benefits. So I started looking at what those benefits were, and like so many government programs, I think there's got to be a catch somewhere. But you know what? This one is really, really great. It has some hidden benefits that most people aren't aware of, that haven't been communicated. And it just so happens that right now is the best time to take advantage of them. And there's many reasons we'll go over in this session. But what we discovered was that several of the assets that we were working on were in the opportunity zone. And we began to put those assets together into opportunity zone funds and describe, define, and make available all those benefits, and have our first 100-unit completed and nearly completely leased asset in an opportunity zone fund. You can find more information on qozportland.com. And we have several other investments in the area. And the reason we focus so much on Portland, number one, we were here already, but there were several independent rating agencies that determined that the downtown Portland area is amongst the top 10 of over 8,000 opportunity zones for its likely growth and emergence as one of the better markets on the West Coast. So it's really the most affordable West Coast market, and it is experiencing cap rate compression, meaning that the assets are becoming more valuable as people are bidding them up. And this is one of the things that we expect better opportunity zones to experience, is an improvement in their assets and their markets. So I hope that was a good update. Or
no, it's great. It's actually a great update. It's an excellent sort of update and sort of lead the panel, because my next question, obviously, as you brought it up, there's actually over 8,700 opportunity zones that have been designated, and are you finding that most of the investment is going into opportunity zones that are in an urban environment, like a downtown Portland, or do they extend to rural and suburban areas as well?
I think the majority of the opportunity zones are in rural areas and suburban areas, but there are many downtown and close to downtown opportunity zones, and those seem to be the most possible for initial investment because their rents are a little higher. so there's a better return on investment. For the Portland area, we've experienced sort of a depressed, if you would, or not a very much rent growth during the pandemic, but we're moving into a period where we're going to experience a lot of rent growth. And those kinds of rent growth numbers are not that common in suburban areas. And we really do need rent growth to overcome the costs, the higher costs that are occurring in the construction industry right now.
Yeah, I can see that. I can see that too. And there tends to be more of a willingness, I think, from an investor standpoint, to help revitalize downtown areas or areas that are considered blighted, than maybe investing in, out in the suburbs or rural areas where they can't really see and touch. Well, let's talk a little bit about investors. What are the different types of investors that you have in your funds? I mean, where are they coming from? Are they individual? Are they family offices? Are they, wealth managers, so on?
We're usually interacting with high net worth individuals that have problems that they're trying to resolve. In other words, they're trying to find a way to minimize their taxes. And I have some background noise, hope it's okay. The high net worth individuals, the family offices, the individuals that have gains from stocks, stock sales, business sales, and most importantly, real estate 1231 gains. These are the most common that we see invest in the opportunity zone funds. So in the case of one of our investments, we have 3 individual investors that have invested over $5 million into one building. And so what we do is we provide a K-1 that allows them to pass through all of the ownership benefits through to their personal tax returns. And this very small structure for each individual asset is beneficial for a lot of these investors. So we're focusing on how to optimize the investment opportunity for each asset and for the individual investors.
And are you finding that the investors now that you're dealing with are a lot more knowledgeable than they were 2 years ago? Or is it still, hey, here's my money, don't lose it?
Yeah, it's really amazing. The investors that we interact with, they oftentimes will start the conversation with, I've already set aside this money to put into an opportunity zone, and now I'm evaluating your assets. It's just that simple.
Right.
And the number of people that we come across that don't understand the benefits are the second group. And perhaps that would be the most common. I would say there's probably hundreds times as many that know that don't know the benefits than those that do. And I think the ones that have already learned about it, they've already figured out what it is. They don't know all the benefits. So when we present some of the hidden benefits, like depreciation recapture is forgiven, that is one of the largest benefits. They just can't believe it. If I compare a 1031 exchange, a real estate transaction, to a new investment of the same size in an opportunity zone fund and extend it out through the holding period, the returns are far better. It also positions the family for better growth over the many years ahead, because the opportunity zone funds are still valid for another 25 years. And most people are only evaluating the benefits for 10 years. So the benefits continue to accrue for 25 years.
Right. And I think that's one of the things that investors are not fully aware of when it comes to opportunity zone fund investment. I think that they just feel that it's got the 10-year time frame, and that's it, and then they're out. And it really does have a longer impact them on a longer basis. How should an investor choose and evaluate an opportunity zone opportunity from your standpoint? What do you think they should be looking at?
Well, there's quite a few. The first and foremost is, what are the benefits that are going to be received at the time of the investment and in the next calendar year? So the initial investment receives what's called a 1400Z deferral of gains. So there's a little form that's filled.
Okay.
I just got muted on accident, so I'm just.
Oh, we just had Daniel, and that's fine. I think you're good.
Daniel.
Just entered.
So we're just talking about the advantages of investing in which year, and in the first year they receive a deferral. Sometimes in the same year they can receive the benefits of depreciation. Sometimes it's in the years following, and then in 2026 they have an increase in their basis from the deferral, which if they are invested before the end of this year is reduced by 10%, and they would pay the tax on that initial deferral. And then 10 years later, from the initial investment, they receive capital gains and depreciation forgiveness, meaning that if they sell the asset and receive all the funds, that would be free of depreciation recapture and capital gains tax. These are incredible benefits. So,
Excellent. No, yeah, I mean, definitely, that's one of the things that I think, again, investors need to be made aware of. I wanted to now introduce Daniel Ocean. Daniel is Chief Strategy Officer with Integris, and Daniel has joined our panel. How are you, Daniel?
I'm doing well, thank you. I apologize for the misunderstanding on the calendar.
That's fine. That's fine. We're good to go. We're good to go. So yeah, I know you can jump right into the conversation. Lane really gave us a nice, primer to some of the reasons or some of the things that investors should look at when they evaluate an opportunity zone opportunity. If you want to add to that, that would be great. What do you feel that investors really need to do to the best way for them to evaluate an OZ opportunity?
Well, I don't want to step on what Lane might have said and repeat, but from my perspective, the single biggest issue facing investors in a QOZ right now is trying to determine how the real estate investment itself has been designed and whether or not it's a quality real estate opportunity before they even look at the tax benefits. A lot of QOZs, in my opinion, are designed as things to attract capital based on the allure of tax benefits. And in many cases, they are not well designed or well underwritten, or they are overpriced or other types of things. So I think the cornerstone of the issue comes from appropriate underwriting and understanding of the real estate investment, and the tax part of it should not wag the dog. In the case of criteria, if you're not a real estate expert to determine whether or not a deal is decent, I would start with some basic things. I would look for sponsors who are highly knowledgeable about the area that they're doing business in, and that have a track record that demonstrates their capabilities. So somebody who's been doing the same thing for an extended period of time and has an extraordinary amount of examples of doing that, and has a reputation, a history, a track record, a capability to execute, at least can give you some level of comfort. So in the case of what we do, and we're a 30-year-old company, been doing the same thing for 30 years. We've cycled on 1,000 investments. We've developed a very large number of investments, and the people who are involved and associated with our project are highly skilled, knowledgeable, and have long-term worldwide track records of doing what they do. That starts to help. We have institutional co-investment partners, which helps people to get a sense that there's some third party that's looking at what we're doing and us as a company, and that helps them to get a comfort level. So those are good starts. The real estate itself still has to be the right kind of real estate. The tax part of it is great, but it only works if the project itself is successful and makes a significant enough return to make it worth not paying your tax and investing in something else. So a low yielding QOZ is not going to offset, no matter what the tax is, the benefits of investing in good real estate, in my opinion.
That's a great insight. Lane, let's go back to you a second. Tell us about Portland and your funds a little more. Give us a little more of an insight into the specific investments that you have in that your fund's making in Portland.
Sure. Well, we're operating in several different types of assets, but most importantly, the multifamily. And most opportunity zone funds are set up to purchase land, develop the property, lease it up, and operate it for a 10-year period of time. But we also operate in original use assets. It qualifies for the opportunity zone, where we buy the building already completed in the opportunity zone, and then we just lease it up. And in some cases, we have assets that have already been leased up or nearing completion of the leases, and they can be purchased as an opportunity zone fund qualifying asset by purchasing the fund, and experience the cash flows that are already built into the operating statements. So there's a unique approach that we have in this regard, that we can bring the investor depreciation and cash flow from day one. When they're entering into the asset, they don't have to put a 2, 3, 4-year period of development with all of those risks. Now, we do invite people to get involved early and to get involved in construction projects, because the upside for the construction is available for the investors and improves the returns. But to receive depreciation in the first year, the building needs to be complete and placed in service. And opportunity zone funds typically can only receive those kinds of benefits if they're already original use assets. So in other words, they're already completed and being placed in service at the time that they're being purchased. So I know I'm getting into some technical areas, but we do offer something that significantly reduces the risk. And what we've determined is that the returns in opportunity zone funds are actually greater for a shorter investment horizon. We can show that an asset sale in 2025 surpasses the returns of an asset sale in 2032 from an investment made today, because they're able to resell to the next party as an opportunity zone asset, and that new party would receive that opportunity zone benefit. So there is a greater return. And we're looking at 3-4% growth rates, and as most cities are, for rent growth. And we're able to model 20-30% returns for these longer term holds. It's pretty incredible. It's because of the opportunity zone benefits.
Hey, Lane, I'm curious, how are you structuring it so that you can buy an existing asset and still allocate enough percentage of capital to it to qualify under the QOZ rules? I think that would be interesting for people to understand, so that they understand how it fits.
I'm not sure the question. How do they allocate enough capital?
Well, you have to put 50% of the money to improving the asset in order to be qualified under the QOZ rules. So if 50% of the capital you're raising isn't going to adding value, how are you buying an existing asset and still doing a QOZ?
Oh, very good clarification. We're not actually buying an existing asset. The investment is made into the stock position, the ownership position in the company. Once a QOZ fund, qualified opportunity zone fund, qualifies, then that fund continues to qualify as long as it meets the semi-annual tests. So the asset cannot be purchased. You're accurate there. What we do to structure it is we set them up in a series of LLCs, and the investment is made at the parent LLC, which is the QOF, as we call it, the QOF, and the asset is staying inside of the QOZ business, the QOSB. And that's how we do it. Have you seen that? Are you using that structure in yours?
No, we are not, but we're just a single asset. So no, we're not using it that way. And I've not heard of that being done, but it sounds like it might work. There's lots of different structures, but I think it's important that there are so many different ways to do this. I think it's really good for people to understand the differences.
Sure. It's interesting because the majority of the funds that we have interacted with, and I do mean the vast majority, are unfamiliar with these methods. When we discovered them and did our research originally of how to optimize the opportunity zone benefits, we immediately structured our investments in this way and had incredible demand. So much so that we can't really get as many of these assets as we'd like, because we're in one of the top 10 opportunity zones in the whole country. So whenever an opportunity zone asset comes available in this city that you see behind me, it gets swooped up pretty quickly. It's scooped up right away. So we're looking diligently to find more, and we're focused on Class A and Class B multifamily, which we expect to have, based on CoStar's reports, 5.9% rent growth next year, 5.4 the year following. And we're not sure they're entirely baking in all of the changes in our supply, because we have a built-in supply constraint in our market that should cause rents to grow pretty quickly. So that's why we're focused on Portland and the particular multifamily asset.
Oh, look, we now have a live shot of Daniel.
Hey, Daniel.
With a guitar.
I was moving from my car to my desk, so
yeah,
the car doesn't really work.
That's I was wondering if you had guitars in your car as well. You know what, you brought up a good point when you asked when you asked Lane a question about their funds. Tell us about Integris and what makes it different from other OC offerings.
So Integris as a company does all kinds of added value projects, including development. We have only one opportunity zone out of more than 50 assets we have. We are not an OZ company. We're a 30-year-old real estate firm that raises money from institutions and private high net worth investors, and has a pretty stellar track record of continually producing returns in all kinds of cycles. The asset itself is called the Dream Las Vegas Hotel and Casino. It's on the Las Vegas Boulevard on the Strip, catty corner to Mandalay Bay. It's a 525 key resort hotel that will start development in the spring, sometime in Q2. It has Dream Hotel Group as its flag and operator, which is if you don't know who they are, they're a worldwide hospitality brand that focuses on entertainment, lifestyle, food and beverage draw. They're one of the highest revenue producers in that genre of hospitality. They have hotels in New York, 2 in New York, Miami, Nashville, Los Angeles. They have all over the world. They specialize in this. This will be their worldwide headquarters. They're on a 30-year contract to operate the hotel. There'll be a separate operator for the casino in order for it to work under the QOZ rules. There'll be a lease with a separate operator. This is considered a boutique hotel at 525 rooms for Vegas. It's big everywhere else, but they're small. But what really is, I think, interesting about this deal is location. We're a 15-minute walk from Allegiant Stadium. We're less than a mile away. They're supposed to have 200 events plus a year there. It's one of the highest producing venues in the world right now. We're adjacent to private aviation. We're adjacent to where Jet Suite X, which is a regional airline, flies into. So we're a few minutes, literally a couple of minutes from where people can fly into. We are the closest new hotel to Southern California for people driving in, which represents about 40% of the visitors to Las Vegas. We have some of the world's best people working with us, including Bill Smith, who works for our company, who built City Center, which is just up the street. It was an 18 million square foot, $9 billion project with Qozportland and other assets in it that he built for Kirk Kerkorian. So we have some great people. We have a great project in an incredible city that's already has casino revenue exceeding pre-pandemic levels. It should be a pretty stellar project. It's expected to produce double-digit cash flow once it's built in 2024. It's expected to produce something in the neighborhood of a kind of base case 14% a year return, trending into the higher teens. And when we give those numbers, they're based on decades and decades and thousands of assets of experience. We are very good at producing results. So it's a really interesting project. It has a lot of unique benefits that only our project have, that differ from pretty much any other QOZ. And that's just kind of a base picture of it.
Do you find that that's actually a very impressive project? Do you find that that's unique in the opportunity zone world, where it's a ground up project, and that the majority of op zone investments are, the purchase of assets and the betterment of assets? Or is this a trend that's growing?
No, I would say 95% of the QOZ investments I've seen are ground up development deals.
Okay.
The vast majority of them are. And part of that is because the QOZ structure encourages that. It is kind of how it's structured, that it works that way. Most of them are multifamily. There are some others. Most of them are ground up developments. Lane's is the only one I've heard of that is structured the way his is. That doesn't mean that one is better than the other. Each one should, you can theoretically have a business that's in a QOZ. You can start, I know some people who started marijuana dispensary businesses in the Northeast that were in the qualified opportunity zone investments. It doesn't have to be real estate, and it doesn't have to be development. By the way, I didn't invest in that, and I'm not part of the marijuana deal, but I'm just pointing it out as an example of how the only thing that matters is you follow the rules of the QOZ. And as you heard from Lane, his way of doing it is one way of following the rules. We're doing another. There are lots of different ways to do it. But most of them that I've seen, the vast majority, are ground-up development deals. What's unique about ours is, while there are not a lot of hospitality deals, we're the only investment I'm aware of in the QOZ world that is a casino hotel. And we're certainly the only one on Las Vegas Boulevard. We're the only investment, even if it wasn't a QOZ on Las Vegas Boulevard, that people can invest money into. You know, that it's a very, very unique type of investment. That doesn't make it better or worse, by the way. It just makes it unique. What makes it better or worse is just whether or not the underwriting and the ability to execute is there. I don't mean to sell that being in Las Vegas is better than being in Kentucky. It's a matter of the deal itself. I think we're in an incredible market. I think there's a tremendous amount of demand drivers for that market. I think it's a very fast recovery market, but that's just an opinion of mine. And I think, you know, when you're looking at these things, you have to make your own decision.
Lane, let me go back to you, sort of staying with this theme of finding investment opportunities. Are you're fixated just in Portland, correct? So you're just looking deals in Portland?
We do have opportunities in other states, but Portland appears to have the best economics because of, we're in one of the top investment areas in terms of opportunity zones. We expect more growth over the next 25 years in this market than most of the markets that we're looking at.
So what are some of the investments that you're currently looking at now, if you can share them with us? Just asset class or type of investment, dollar amount possibly?
Sure, we have a 100-unit Class A apartment that's a few blocks from downtown Portland that is 85% leased, and we're going to make that asset available on a stabilized basis, which will provide a first-year investment return that's based on the deferral and of capital gain and the depreciation. So I believe the asset has approximately 23 or 24% cost segregated depreciation. This means that the personal property inside the building becomes available as a first-year deduction under the bonus provisions for depreciation, and combined 1400Z and depreciation benefits in the first year, in some cases, depending on the investor's position, could create as much as 100% tax deduction in the first year. So for each dollar invested, they may receive up to 100% as a deduction. Now, if they're one of the unique individuals who is investing 1231 gains and they're not netting them out, they're investing the gross gains, they could experience more than 100%. And this is a unique opportunity. And I make myself available to, if you will, coach people on how to optimize their tax positions so they can increase the amount of available dollars that they can invest in an opportunity zone fund. So if anyone has any questions, just on their individual.
Yeah, I should have mentioned that too. If anyone has any questions that's listening, feel free to put it in the chat, and we'll bring that in to the panel. You brought up something which was about taxes. Let me go back to Daniel a sec. What about state taxes and other income, tax type ramifications? How is that addressed?
Well, I think a lot of people misunderstand that the QOZ benefits are a federal benefit. So it's federal tax related. On a state level, each state handles things differently. There are a number of states that adhere to the federal QOZ rules. There are many that don't. So it depends on where you live. But if there are a number of QOZs that happen to be in California, ours isn't, and Lane's aren't. So we're not talking about the ones that are on this call, but it's an issue that affects a lot of people. There are a number of well-known QOZs that are raising money for California assets. And if you don't live in California, you still pay California tax. And so for a lot of people, that is a big negative for them. I wouldn't, again, let state tax wag the dog. but it is something to be very aware of, that each state has its own state tax circumstance, and you need to address that for where you live and where the asset is domiciled, so you can understand how the tax will affect you. I think that answers your question.
Yeah, that, I mean, definitely just, again, we talked about most individuals that get into an opportunity zone, fund, or they invest in opportunity direct, they have advisors. They have, they should have a CPA, or they should have a tax attorney or someone that advises them. Are you finding that individuals have that knowledge, more of that knowledge now than they did a couple of years ago? I posed that question to Lane earlier. Or are you finding that they're still coming in and saying, explain it to me?
I find that most CPAs know very little, if anything, about QOZs. I can start with my own CPA, who, when I brought up the idea of a QOZ when we were first working on them many years ago, didn't know it, hadn't even heard of a QOZ. And today I'm working with another CPA who has me on the phone with his clients as a favor to him, because his knowledge of QOZs is limited to the few pages that he's read. Just because somebody's a CPA doesn't mean they're knowledgeable about all things. And while QOZs are a bipartisan supported, well-known tax strategy that is allowed by the federal government, it doesn't mean a CPA is knowledgeable about it. So I would urge people to either find a CPA who is, or if their CPA isn't, to get an expert involved that can help them to make sure they're making the right decisions. As Lane mentioned, I mean, he's super knowledgeable about the tax, more than most people that I've met. And while I'm sure he would tell you he can't provide tax advice any more than I can, somebody like him or somebody like me can help to do that. But in the end, you need your own tax advice. And if you have an accountant that doesn't know the difference, you can get yourself into trouble. I mean, I can tell you a lot of them don't realize you can use short-term gains. They don't know about the 6-month timelines. They don't know about whether if it's about when you book your gain. And so if you have money coming in through a partnership or K1s, the timing's different than if it's individual. Those are a lot of things that people just aren't aware of. And I can't tell you how many people don't know that depreciation is not recapturable on a QOZ. I know Lane knows, and I'm sure he's already brought it up on this call before he even got on it, but the lack of recapture on depreciation is a massive benefit, way more important than the 10% reduction in basis.
Lane, 1031 or opportunity zone fund are both an option for an investor. Which one is a better option for them to put their money into from a tax standpoint?
Well, we have done the evaluation for several assets ranging from partial, about 50% basis, to almost zero basis. What people are doing in a 1031 exchange when they're selling a real estate asset, or most assets that are exchangeable, they are dragging their basis over into the new investment. They have to reinvest the entire amount. Any amount that they don't invest, they would then pay capital gains or some tax upon. In the opportunity zone, they only have to take their gain. So it's the difference between their sell price and their basis. So once they enter into the new asset, the opportunity zone fund, then they essentially get a new basis in the asset based on the allocation of debt that comes on the project. So I always encourage increasing the investment much greater than was before, because the increased investment provides depreciation to offset the tax that would otherwise be due and will become due in 2026, 2027. So that depreciation is ultimately forgiven. So the larger the investment, the better the investment results for the investor moving from a 1031 into a QOZ investment. I mean, there's a lot of other reasons, but that it's primarily because they get reset basis and forgiveness of the depreciation. It's just better than a 1031 exchange in almost every circumstance. There's a few unique situations when there's literally a zero basis in the asset, where they might be experiencing more tax than their depreciation will offset, and their 1400Z deferral. But in most cases, it's a much better investment. in virtually every situation I've seen.
Daniel, what's your feeling about that as well? I mean, just add to it. I know you're probably on the same track, but what are your thoughts?
I agree. I don't have anything special to add there.
Right. Yeah, I would think that. We talked about who should be looking. I asked Lane this earlier at OZ funds. Daniel, who do you believe should be looking at opportunity zone funds? Large mutual funds, individual investors, family offices, RAs. I mean, who should really be looking at op zone funds?
Well, anybody who has a gain. So the opportunity zone is only of the benefits of it only work for qualifying capital gain investments, which are short or long-term capital gains within the 6-month window from when you book your gain. That really applies primarily to individuals. It works for some businesses that have gains, some funds and things like that. It doesn't really work for larger private equity. They're not typically looking at it. There are some qualified opportunity funds out there that are designed by private equity firms, but in terms of just straight cash doesn't get the benefits of a QOZ. So there are cash investors in our deal, and I'm assuming Lane may have those too, who are looking for just having a great real estate deal. But from a QOZ perspective, it's individuals. And then within that, as you already talked about, you have 1031 eligible investors who choose to go down this path. You have people with broken 1031s. You have other kinds of semi-exchange or exchange eligible concepts that work better in this environment. People who've sold businesses, people who have gains from literally almost anything that would be that qualifies as a capital gain fits into this. So you have people who have stocks they bought, and some of them are short term, but they have significant gains. They don't know what to do with the stock. They don't want to sell it and have to pay the tax. And so they look at it from this perspective. I had a call yesterday with a CPA and his clients who had sold a business. They have a very significant gain, and it's an old business, and they have a lot of a very low basis and a huge amount of gain. And this is really the only option for them to avoid tax for the 5-year period, and then to have all the gains generate tax-free returns. So it's a very unique structure that works for pretty much anybody who has a gain and doesn't want to have to pay the tax, or at least not pay the tax now.
Let's address, I guess, something you can say, the elephant in the room about the Biden administration has threatened to reduce the benefits of opportunity zone, and in addition to raising the capital gains tax. What's your feeling about that? And are people nervous, and are they bringing that up? Is the clock ticking, I guess, is the question.
You asking me first?
Yeah, I'll ask you first, then Lane.
Okay. I personally, well, first of all, nobody has a crystal ball. I don't know what's going to happen in the 2026 tax year, so let's just start with that. From a tax perspective, a regulation perspective, nobody knows what 5 years from now is going to bring, who will be in office and under what rules. But even under the worst of fears, the amount of additional tax somebody would pay on their gain is, in my opinion, based on any kind of math, negligible compared to the power of getting tax-free income to the degree that it's covered by depreciation that isn't recapturable, and tax-free capital gains that come from refinancing and sale. Such an enormous power. The tax differential should be insignificant, particularly if you invest this year and you get a 10% reduction in basis. That just further enhances the overall yield of it, but it's a math question. So it's really a matter of what's your tax circumstance? What do you think in your mind is the worst thing that could possibly happen? And would you rather pay your tax now? And, if it's long-term, where I live, it's 30-some% in tax. If it's short-term, it's 50% in tax. Would you rather have half your money and then have to invest it and to take half your money and make back to par? You have to double your money. So now you have to double your money to be able to get to the earning power of what your money will be in something like this for a 10-year period of time. And then you get all those benefits tax-free. It's very hard to see how an increase in the tax would make much of a difference.
Lane, what are your thoughts on that? Is the clock ticking? when it comes to OZ funds and investing in OZ?
I believe that OZs are here to stay and that there will be very little legislatively that will water them down or make them less attractive because they were bipartisan and continue to be so. We've been in touch with some of the legislators about enhancing the legislation to benefit people in the zones more than just the property owners. But sticking to the tax portion, the Opportunity Zone Fund is a way to defer the taxes. And that can be done at any time. That money can be removed and then the tax is paid. So if you were to, a person was to invest money into a fund and not pay the tax and it's not due until 2026, they could essentially borrow from the government the entire amount of what they would otherwise be paying in tax for a full 5 or 6 years to invest. And I cannot imagine that an increase in tax rates for capital gains would be more than what could be earned for 5 or 6 years on an investment of that type. So I do want to point out that not only does the money that's invested earn money based on the cash returns, but it also receives the benefits of depreciation. We have taken a completed asset and put it into our model using normal rent growth and the benefits of Opportunity Zone deferral with the depreciation, and a 2025 sale generates more than a 20 IRR without getting the benefit of the 10 years. If you go out to 10 years, it comes in just a little under 20. But where do you get an opportunity that has those kinds of 10-year returns in something as safe as a multifamily asset that doesn't have development risk? It's incredible. And there's additional benefit. If someone decides to stay in a fund long-term up to 25 years, they essentially receive nearly the entire basis of the asset if it's multifamily during that period of time, and then it's forgiven. And this isn't talked about. The reason why now is the most important time to invest is the Opportunity Zone depreciation forgiveness is based upon the amount of depreciation that's received from the time that a person invests in it till the 10-year hold period. And we are in a period of 100% bonus depreciation, which begins declining in 2023. So each year it starts to go down. And if someone invests in an Opportunity Zone fund today, the asset needs to be completed in the next 2 years for them to receive the 100% bonus. In the next year, 80% bonus depreciation. And I know these are complicated areas of law, but I can coach a person and their tax professionals to maximize their results in their investments. And we have designed our funds to take advantage of them. And if you receive 100% bonus and get a markup to fair market value and there's no recapture, a person is much better off receiving a larger bonus depreciation than they would be if they don't get that bonus. And that's why now is the time to invest, to take advantage of the development cycle and or an original use asset and receive more depreciation.
Excellent. We're gonna start to wrap things up. If there's any other information that you want to add, Daniel, specifically about some of the things that you're doing, about Integris, about, you're very thorough with the hotel, which is very impressive. What else do you guys have going on?
I'm going to stay focused on our QOZ. We do a lot of different things in the way of development projects and other things. And if you're interested in non-QOZ things, I'd be very happy to, after the call, walk you through that. Ben Matheson, who works for me, who is heads up this area, is very knowledgeable and can help with that. But on the QOZ side, I would encourage people to look at the total picture of the QOZ and not just the tax benefits. And again, very, very important to focus on the real estate side of it. In our case, we have one of the most high profile and interesting real estate deals that I think people will ever see. And one of the benefits I didn't mention of it is we have a unique founders club that's part of it for qualifying investors who invest in the program. They receive ownership benefits for being a part of it. So when you go to Vegas, you can be picked up at the airport and have VIP treatment and front of the line access, and room upgrades and credits and all kinds of things go to our box at Allegiant Stadium if you qualify, or other things like that. There are all kinds of benefits that come with that make this a very unique investment.
that's not an economic benefit, still doesn't make it a good real estate deal, but I think there's some very interesting parts of it. But in the end, the real estate's going to play out. And I think that what we drive that's very unique is we have a 30-year history of performance, 1,000 assets that we've cycled on, a significant average annualized return that bears out what we're doing, and the strength and expertise internally to be able to make people comfortable with our institutional partnerships, that we were providing something that is sustainable and will actually produce the results they're looking for. Because if it doesn't, those QOZ benefits are useless. They're only beneficial if you have the project is successful.
So let me get this straight. So if I invest in a self-storage facility, I get an investment in a self-storage facility. If I invest in the dream, I actually get additional benefits as from an investment standpoint. That makes a lot of sense. I get to go to Raiders games and so on, and have a great time in Vegas. I like.
Yeah, no, it is entirely true.
That's great.
And we don't have that in our other deals. I mean, if we're building an apartment building, we're building this, we're building that. I can go to the apartment building, I can see it, but I can't enjoy it. I mean, I don't even go to the pool. But right here, you get all the benefits and interesting things that come from that, which is exciting. I mean, like I said, again, it's not a reason to invest, but for some people who like Vegas, it's an exciting addition.
Well, that's a trend. I mean, from the standpoint of investing in multifamily, or I should say, buying condos, just straight buying a condo now in Miami and South Florida, you have branded condo buildings where the added benefit, we have a nightclub here, Club 11, that's partnering on building a building here, and people are buying condos in that building because of the added benefit. So why not have that for an OZ, an opportunity zone type of an investment as well? Lane, we're wrapping up here. Lane, anything that you wanted to add to tell us really more about where you see the OZ funds going, and really the benefits in Portland, which is very exciting as well?
I make a commitment to lead the field with opportunities and strategies to maximize people's investment results. And one of them that I do is I deliver original use assets or leased up assets with opportunity zone benefits that essentially removes the risk that everybody has been so concerned about, the development risk, and delivers the tax benefits earlier. So we have several assets that range in size from just as small as 40 units to several hundred units. We're also involved in affordable housing developments, which we can couple with opportunity zones. We're quite aware of the 14 states that have full conformity with our laws. If you have any questions, if anyone has any questions about how they work and how to maximize their situation, please give me a call. I'm at Qozportland.com, and we can point out which types of assets are the best. And I would really like to be involved also in the Las Vegas Strip. I think that people should spread their investments around. And in some cases, these 100-unit buildings or 200-unit buildings are the right size for the family office or the high net worth individual. And we can offer an individual asset that they can hold for 25 years. And we invest shoulder to shoulder with them with our own funds in an LP position and take our sponsors' interest at the end. So what has made opportunity zones difficult for people to understand is the complexity of it, and we simplify it, explain it in detail to the individual and their tax professionals so they know how to fill out the forms and take full advantage of the opportunity.
We actually have a couple more minutes. If Dan, if you want to add something additional, please feel free. We're a little bit short.
In what Lane has I probably should have done from the beginning, and I'll do it now. If you're looking to contact us, the easiest way is to go to Integris INV or IntegrisInvestments.com. Either one of those will work. It is we have the information about our fund and our company there. You can reach out to us. Be happy to take you through that. What else can I tell you that I think would be interesting? You can call us at 84-INTEGRIS. It's INTEGRIS. I did see a question. I don't know if we got this question answered, but just to repeat if we already did, you have to hold the investment 10 years from when you invest in order to qualify for QOZ benefits. So the depreciation, recapture issue, the lack of tax on the capital gains, all that stuff is dependent on a 10-year hold in the investment. Now, that doesn't mean the real estate itself has to be held 10 years. I think Lane said that they're planning to sell possibly in the middle and then maybe buy other things. I don't mean to put words in his mouth, so I'll let him speak for himself. But you do have to hold your investment in a QOZ for 10 years from the time you're in. So in our case, it'll be 10 years from when the last investor comes in. So if you come in today, you might be 6 months ahead of somebody else. It doesn't mean on the first day after the 10-year period that you're going to see a sale. It's sometime after that. And as I think Lane mentioned, it can be much longer than that if it's in the benefit of the investors. In our case, we're planning to hold it 10 years and then to sell it. Every deal is structured differently.
And investors are still knocking on the doors. I mean, that hasn't slowed down from 27.
No, it's speeded up. It's the other way around. With the amount of money being raised right now is more than ever in QOZs because people are becoming more and more aware of it. And you have the 10% reduction in basis ending at the end of this year. So there's an avalanche happening in December this year.
Yeah, there's more of an intense period, to do that. Well, listen, I want to thank you guys, definitely Lane and Daniel, for taking part. Very informative. For those of you that are listening out there that want information, feel free to send an email in to FIA, add your information on the chat. We'll make sure that we provide your contact info to Lane and Daniel. And thanks again, guys. Really appreciate you getting involved.